In this video, we're going to do a ratio analysis of Walmart, and we're going to calculate the numbers for the most recent year for Walmart, working through each one of the ratios that we've learned, starting with the current ratio that we did last week and continuing with all of the ratios we covered today. So we're going to put our values for the most recent year, we're going to do these calculations, and then we are going to get the measures for the prior years straight from the internet. Okay, so I'm going to start by finding Walmart's 10K. So I'm going to start by searching SEC Edgar company search. I'm going to put in Walmart's ticker, WMT, and I'm doing this out in case you want to follow along with me. The filing type is 10K. And let's see, so we see this is the year 2017. I'm going to choose interactive data so I can easily view the financial statements. Click financial statements. And if we are starting with the current ratio, I'm going to need to start on the balance sheet, but I'll need both the balance sheet and the income statement. So again, the first ratio that I'm going to work through is the current ratio. And the current ratio, remember, is current assets divided by current liabilities. So let's see what these numbers are for Walmart. Current assets, I see here in this cell, 59664. Go back to the balance sheet for the current liabilities, and I see right here total current liabilities 78521. Oops. And this works out to be 0.76. So I can see that, remember last time we said it's typically greater than 1. Companies typically have more in current assets than they do current liabilities, which is considered to be safe. You can pay off those short-term debts using your current assets. We can see here Walmart is below 1.0. This is not enough information to say that this is a risky company, but it's a first, maybe not quite a red flag, but maybe an orange flag. Now the next thing I'm going to do is find the prior years rather than calculating all of this out. I have the information in Morningstar, is one of the few websites I know that gives ratio data for free. I don't need any set up any special account. All I did was Google the words Morningstar Walmart financial ratios, and I got to this screen here. Sorry, that was the wrong screen, so I've now pulled up the correct screen for Walmart financial ratios on Morningstar. And I see down here key ratios, and they are separated based upon profitability, growth, cash flow, financial health, and efficiency. So our current ratio is probably going to be under financial health, and sure enough, here it is. The current ratio, I see it by year since 2009, and so we can look across this row here and look at this trend in the current ratio. Went from 0.88, it was most recently up to 0.93, and then it's coming down. So 0.76, this is what we just calculated. Prior year it was 0.86, so let's pull that in. So this is not a favorable trend. The company is getting less liquid. Okay, now we're going to start with the ratios that we've done today. Let's look at the accounts receivable turnover ratio, which is equal to sales divided by average net accounts receivable. And let's go to, if we need sales, we need to get the income statement, but since I already have my balance sheet up for Walmart, I want average receivables, and here in this line here I see, the net receivables. I'm going to take the average between this year, the 5614, and the prior year, 5835, and divide that by 2 to get the average. That average is going to work out to be 5724.5. And to get the sales number, I'm going to go to the statement of income. And I can either use the net sales or the net revenues. What's the difference here? Well, this is sales to customers. This is membership. So Walmart membership. Now we know we don't need a membership to get into a Walmart, but we do need a membership to get into Sam's Club, which is owned by Walmart. So presumably this line of membership is the membership fees charged by Sam's Club. So what do we want to use? Net sales or net revenues? Arguments could be made to support either one of these. Let's take our total revenues, 500,343. Sometimes financial analysis is a bit of an art and not always a strict science. So this will work out to be the turnover 87.40. We can interpret this to mean that Walmart collects its accounts receivable 87 times during the year. Let's compare that to the prior year. So I'm going to go to see what Morningstar gives us for, I'm going to go to the efficiency ratios and receivables turnover here in this line. Here's 87.4 we just calculated. Last year was 84.8. So from last year to this year, did the accounts receivable turnover improve or deteriorate? Remember, we want it to be higher, so they did show a little bit of improvement in the accounts receivable turnover. Days in receivables is just a manipulation of the accounts receivable turnover. We take 365, the number of days in our sales period, divide it by the accounts receivable turnover. And this works out to be 4.18. So we can interpret this as, on average, it takes Walmart 4 days to collect their receivables, not very long. We can look at last year's numbers, or we can simply take the 84.8 of last year, divide 365 by the 84.8 from last year, and we're going to get 4.3. Since this was just a mathematical manipulation, we're not going to see any differences here. Of course, the most recent year was performing better than the prior year. Let's look at now inventory turnover. Cost of goods sold divided by average inventory. I want to gather my cost of goods sold from the income statement and average inventory from the balance sheet. Cost of goods sold, I see here in this cost of sales, 373,396. And for average inventory, I want to go to the balance sheet. And here's my line for inventories. I'm going to sum 43,783 plus 43,046 divided by 2. You can see here that their inventory level didn't change that much. And that average inventory level is equal to 43,415. So the inventory turnover works out to be 8.6. The prior year, if I look at Morningstar's ratios, inventory turnover here on this line, we can see the trend over the past 10 years. Here's the 8.6 we calculated, was 8.26 in the prior year. So slightly better than the prior year. It is slightly better now than it was in the prior year. Now let's do our manipulation to turn inventory turnover into days in inventory. Simply take 365, the number of days in that cost of goods sold period, and divide that by the inventory Divide that by the inventory turnover. So for the most recent year, we're going to take the 365 divided by this 8.6, which works out to be 42.44, and we can easily calculate it for last year or look simply at the Morningstar information and get that days in inventory last year was 44.19. So we can see compared to last year and the current year, or the most recent year, Walmart's inventory is spending less days on the shelves, so that is some improvement over the prior year. Let's look at return on assets. What is the point of companies investing in assets? They use their assets to earn revenues, and with revenues come expenses. The takeaway for the investors is net income. So let's look at that relationship. How much income was produced by average total assets? And we haven't gotten the income numbers before, so we have to go back to the income statement. Most recent year, and I see a couple different numbers. I see the consolidated net income, then I see that broken down into the net income attributable to the non-controlling interest and attributable to Walmart. What does that mean, you're probably wondering? Well, the accounting rules for consolidating companies that own other companies say that if the company owns more than, and I believe it's 75% of the common stock of a subsidiary company, the parent company will consolidate 100% of the assets and the liabilities, 100% of every line here on this income statement. But it doesn't own 100%. We have one simple line to adjust for that portion of the subsidiary that the parent company does not own. So that's what we see here. Now, we can make arguments that we should take the consolidated net income or that we could take the income just attributable to Walmart. I tend to prefer taking the income that is the consolidated, including the non-controlling interest, because, well, in this case, we're comparing our net income to our average assets. The average assets number that we see includes all of the subsidiaries, so we might as well use the income that also includes the entire subsidiary. So this is 10,523, and average total assets. I'm going to go to the balance sheet. Here is the line for total assets. I'm going to take the average of 204,522 and 198,825. I'm going to get average total assets of 201,674. And this works out to be 0.05. So this is a return, and we can look at this return and we can test that for reasonableness, and if we're going to put our money into a bank account or certificate of deposit, into a bond, would a 5% return sound reasonable? And then we think about a company such as Walmart. We can think about the risk level of a company like Walmart, a 5% return. Now, this is not return on equity, it's return on assets, but 5% sounds about reasonable, ballpark reasonable. Let's go to Morningstar to see what was calculated for the return on assets, not in efficiency. Let's see if it's in financial health. Now, let's see if it's in profitability. Here it is in profitability. Return on assets percent, it was as high as 9% in 2011. Here's our 5% that we just calculated. Last year it was 6.85% or 0.69%. So we can see that the return fell quite a bit in from last year to the most recent year. The next measure we're going to look at is asset turnover. And that is equal to sales revenue divided by average total assets. How well did the investment in total assets produce revenue? So our sales revenue, have we used sales? Yep, 500,343. Divided by average total assets, which we used above, 201,674, works out to be 2.48. Now, this is not a percentage, this is a number. We would say that our sales revenue is about 2.5 times greater than our investment in assets. Let's look at what it was last year. So let's go to Morningstar and let's look at our asset turnover here. It's been hovering around 2.5%, 2 to 2.5%. Last year was 2.4, oh, not percent, sorry, 2.5 times. And this is the 2.48 that we calculated just now. Last year it was 2.44. So did the asset turnover improve or decline? Clearly it went up, but only slightly. Our investment assets produced a little bit more revenue in the most recent year. Next are 3 measures of profitability. First, earnings per share. We did that last class. Net income minus preferred dividends. Now Walmart does not have any preferred stock, so it won't have any preferred dividends. And divide that by the weighted average number of common shares. And we can easily get this number because the earnings per share is actually given on the face of the income statement. That is required by the accounting rules GAAP. And here we see basic net income. We want this. Oh, here's our weighted average shares outstanding. So if we don't want to use attributable to Walmart, if we want to take our whole net income, consolidated net income, 10,523, and divide it by our, we can't divide it by the number of shares because it only makes sense to have the number of shares held by Walmart, because this is what the Walmart stockholders, the number of shares that they have, and this is, so we're going to clearly look at not the net income, not the consolidated net income, but the consolidated income attributable to Walmart. So now we want this 9862 divided by the number of common shares, which we see here. We're going to take basic 2995. And we should be getting exactly the number that they're reporting here. The basic net income per common share, 329. Oops. So each shareholder can say that their piece of the earnings for the period was $3.29. Of course, they're not actually getting that in cash. It's just a way of analyzing Walmart's performance. And what were earnings per share last year? I don't even need to go to Morningstar. I can simply come to the basic net income per share. Last year was $4.40. So did we see an improvement or a decline in earnings per share? We saw quite a significant decline from the prior year to the current year. Next, we have the gross profit rate. Which looks at how much of the company's sales ended up as gross profit. Remember what gross profit means. Sales minus cost of goods sold. So let's go to the income statement for this. And what's interesting about Walmart's income statement is it doesn't give us a line for gross profit. So we need to, we need to calculate gross profit ourselves. So we're going to take this total revenues of $500,343, and from that we're going to subtract out cost of sales, which is another way of saying cost of goods sold, $373,396. And divided that by the sales number, $500,343. And this is going to give us a rate of 0.25 or 25%. So we can consider this to say that Walmart on average is marking up its goods over cost by about 25%. If we look at the prior years in Morningstar, this should be under profitability. Let's see. Oh, it doesn't look like they don't give it to us in profitability. Let's see, here it is up here, the gross margin percentage. It's been hovering about 25%. Here's the 25.4% we just calculated. Last year was 25.6%. So it has not changed very much in the way that we've rounded. It has decreased very slightly. So the gross profit rate tells us about how well they are selling above, their sales are above a cost of the sales, but cost of goods sold is not the only expense. The profit margin rate, or the net margin rate, takes into account all of the expenses. So of our sales, how much remains as net income? The net income number we are going to use, we could use either the combined Walmart plus the non-controllable interests, or we can simply use the net income. Let's use because the sales number includes this sales number right here, includes the 100% of a non-wholly owned subsidiary's sales. Let's use the consolidated net income that we see here, not just the Walmart portion. So 10,523 divided by sales of 500,343. And what is the profit margin rate? What percentage of sales ends up as income? 2%, 0.02. And let's look at how that fared last year by going to Morningstar and looking for the profit margin rate. Here they call it net margin, and we see that it has been ranging from 3.3 when as high as almost 4%. It's now at about 2%, and last period it was 2.8%. So we see a bit of a decline in the profit margin rate since last year. So let's take a look overall at how Walmart is doing simply compared to the prior year. It is less liquid as measured by the current ratio, although we do see a slight improvement in the days in receivables and the days in inventory. We see quite a bit of a decline on return on assets, so perhaps Walmart might be thinking about selling some of its equipment, some of its actual facilities, some of its stores, in order to see if they can produce the same income with perhaps fewer assets. Their assets are doing a slightly better job producing revenue. So while the asset turnover went up, the return on assets went down. What does that tell us? It tells us that expenses have increased quite a bit over the prior year. We see that earnings per share went down over $1, so that was quite a bit. Gross profit rate was about the same, but the profit margin rate decreased, which we had already seen when we compared the ROA to the asset turnover. So overall, I would conclude that Walmart is doing slightly worse compared to the prior year, and I would, of course, want to see more years of information before I made any serious conclusions about whether I was going to hold on to the stock or not. All right, so that is the end of our series of videos, or the end of class if this were Tuesday night. Now what I would like you to do is work on the practice questions and check your work to the solutions that are posted. I'll see you in class on Tuesday.